Hello, my friends. Brett Pattison coming at you from the financial capital of the West, Salt Lake City, Utah, joined by the chairman.
How you doing, Brett?
I am doing fantastic
Good.
today, Brian. In
Good.
fact, market had a good day. It's had a good year. We'll talk about that another time. What I want to talk about, what we want to talk about, is you came into the office this morning, you walked in, and you asked me a question. And then we talked for probably, I don't know, an hour around this question and how obviously it pertains to clients because it's about clients.
Right.
And I want to ask that question and have that similar conversation with you right now.
Okay.
Because the one thing we wished we would have done is just had microphones on us earlier as we were talking about it.
Hit record.
Hit record.
Yeah.
So we're recording now. So here's the question you asked me. 2 years ago, in March of 21, here was the scenario. The 2-year, this is crazy, by the way.
Yeah.
The 2-year at 0.13%, inflation at 2.6%, and the 10-year at 1.42. Okay, so I'll say that again. 2.6 inflation, 1.42 10, and 2-year 0.13. Under that situation, a client comes to you, or a potential client, or whatever. They say, I have $1 million to invest. What would you put me in? What would your answer be back then?
Well, number one would be, what's your objective? What are you trying to do with this money? That's a question you always ask.
And when the market's good, I mean, let's be honest. The market was good back then. And when the market's good, people 9 times out of 10 say, I want growth.
Yeah.
Because everyone's feeling optimistic because the market's good. So
Yeah.
that's my response. I want growth.
Yeah. At the time, fixed income, conservative investments just didn't make a whole lot of sense. The only reason one of the main reasons we bought fixed income, say 2 years ago, or even really the last decade, was really to dampen volatility. The objective was not to get a return on your money, maybe a return of your money, but not a return on your money, if you understand what I'm saying.
Mm-hmm.
And so that was kind of the scenario back then. Today, the world has changed dramatically. Today we have.
So wait. So back then, sorry to cut you off, but
No,
back
good.
then, somebody says, I want growth. That's my objective. Because again, most people in a bullish environment feel optimistic.
Yeah.
So whether they need growth or not, 9 times out of 10, they say, I want growth. So what would you have invested in back then?
Well, if somebody wants growth, that's how we would have. That's the portfolio we would have recommended.
Stocks.
Stocks, own business.
The best businesses in the world.
Yeah.
Our 4 criteria, our process.
Right. We buy businesses. We're business owners, and that's what we'd recommend. Yeah, and that's what we did recommend, and yeah, absolutely.
Right now, we have a 2-year at 2-year 4.81%.
Mm-hmm.
A 10-year at what's the 10-year now? 4.08%. So just over 4%. Okay. So 2-year at 4.8, 10-year 4%, inflation 6.5%, 6.4%. Okay. What would you do for clients now?
Wanting growth?
Yeah.
That's still the same question, wanting growth.
Yeah.
I still believe stocks is your best option if you want growth for a long-term investor.
Okay.
And so it really hasn't changed. But with that said, the world has changed. Financial markets have changed dramatically over the last 2 years. Dramatically.
Yeah.
One of the key inputs in calculating the value of a business is the discount rate. And the discount rate is the risk-free rate of return, which is the U.S. 10-year. Usually we use the U.S. 10-year treasury. So 2 years ago, the 10-year was at, remind me again, what was it?
1.42.
1.42.
Today, 4.08.
Today, 4.08.
Yeah.
Now, inflation's still high, so you're still losing money.
6.4.
Yeah, inflation's
Explain that. I'm still losing money. What do you mean?
well, so inflation, the cost of goods and services is right now averaging about an annual increase of about 6.42% on every year.
Yeah.
And if you buy say a 10-year treasury or a 2-year treasury at 4 or 5%, you're going to lose 2.5% annually on your purchasing power. So you're not going to keep up. Now the big question is, the $1 million question is, where will inflation be a year from now, 2 years from now, 5 years from now? If you believe inflation is going to go down, I do. I believe it will over the next, I don't know how long. Is it 6 months before we get back down to where I don't know that inflation is going to get down to, so the 10-year prior to the last couple of years, inflation averaged between 1% and 2%.
Yeah.
Just fluctuate between 1% and 2%.
About the same as the 10-year. The 10-year was a little bit better, but not much.
Go back 20, 30 years ago when I was new in the business, inflation, the number we always used was about 3% inflation. Now, we haven't had 3% inflation up until recently.
Yeah.
It's been a long time.
So here's what happens, though, and here's where the conversation and really the biggest question comes in, is those clients that came to us 2 years ago feeling optimistic because everything was going higher, they're now saying, oh, man, I don't know about all these, I don't know about the volatility of the market. Even though the market's rallied this year, everyone still is expecting, because everyone's so pessimistic, the market to fall.
Right.
So now those same people are coming back saying, you know what? I don't know, man. I think that this and this is going to happen and the market's going to fall another 20%. I better move into fixed income.
Okay.
So there's two things to that. Number one, no one knows what the market's going to do. Number two, would you move people that were invested in stocks in our all cap portfolio or our Zion's growth portfolio? Would you move those people now? Okay, you've got a 2-year at 4.8. Would you start transitioning that portfolio to be more fixed income, because now there is fixed income if they wanted it?
So this is the conversation we had.
Yep.
And I would tell people, what we want to do is give people the facts and give them our advice. But ultimately, it's the client's decision on how their money's invested.
Okay, so give me the facts here.
The facts are long term, I believe. Well, and
what's long term?
Long term, 3, 5, 10 years.
Okay.
Stocks, owning businesses you'll get your best reward owning businesses over the next 3, 5, and 10 years.
So to your point, since 1999, our core businesses, right? Our portfolio of stocks, the best businesses in the world, has averaged just over 10%. For the sake of math, let's say it's averaged 10%.
Give or take. Let's give or take. Yeah. Yep. Somewhere around there. Yeah.
Okay. Somewhere around 10%. That's the baseline. And we know that average returns are never average, meaning we hardly ever see a 10% year.
Right.
But that's the annualized number.
Right.
Okay. So that's 10%. So when you say just the facts, explain that more to me. When somebody says, and you had this conversation with a client just the other day.
Yesterday.
Yeah. And I have had this conversation several times this week already. And we did a podcast kind of on it last time. What's the facts?
Well, so I think might be helpful to tell a little bit about my conversation yesterday with a client. Because I don't think it's unique. I think the way he was feeling is very common among a lot of our clients and investors out there. So we recently have been rebalancing portfolios. We do that about once a month based on our research, what stocks we feel like are the best buys.
We call it bi-week.
Yeah. And we added to one of our positions. It happened to be Amazon. And
that's not a recommendation.
Right, not a recommendation, but we added in his portfolio, we bought some Amazon. he asked, he says, "Why are you buying Amazon? I mean, this economy's terrible. We recession's coming. There's got to be a recession sometime in the future before
Yeah.
to kick inflation." And I said, "Well, the reason we bought Amazon is because we believe it's a good buy. We believe the value there is attractive, and looking out over 3 years out from now, 5 years out from now, we think we'll look back and say, hey, that was a good purchase.
Great purchase. Yeah.
Yeah, 6 months from now, I don't know. We don't know what Amazon's going to do day to day, or any stock what it's going to do, or business, the price of the business will do from day to day. But we're looking out. We're long-term investors. We're looking out 3, 5, and 10 years, and I believe that a company like Amazon, if great business, competitive advantages, great management, will be a good purchase.
And his response was,
Well, he just felt like, hey, the next 6 months, the next year, it's going to be really tough, and we'll get a chance to buy it cheaper. And I'd say, well, that's possible. That might happen. I've heard Buffett over the years say that he doesn't base his investment decisions based on what his forecast or anybody's forecast is for the future. If a business is attractive and makes sense and looks attractive, the price, and it's a great business, he buys it.
yeah.
Regardless of what the forecasts are, because it's impossible. He said in his last annual report, he said forecasts are worth or less than useful. So I think that was something like that. They're less than useful, or something to that it was. But I mean, forecasts, as we know, we've talked about before, they're impossible to make. What they do is they actually cause people to freeze, deer in the headlights, and overanalyze and say, instead of saying, hey, Amazon makes sense, let's buy it because it's a good business and the price is right. But a lot of times people say, well, it's going to get cheaper next week or the week after, they think.
And nobody knows.
And you don't know. I've been doing this for 30 years. I promise nobody knows what it's going to do.
So this particular client wanted to go more out of stocks into fixed income.
Yes.
Okay, so what's the facts around that when you say just the facts?
Well, I mean, the facts are, in my mind, these are the facts. I mean, I don't know if you can say these are. We can't say that the stocks for sure. The fact is a fact that you'll make more money in stocks than you will in bonds over the next decade. I would take that bet. I would
every day.
Yeah, I believe that's the case. But so that, in my mind, when I say the facts, that's and historically, stocks have outperformed bonds. If you believe interest rates are going to go up, guess what? Bond prices are going to go down. Bonds had a terrible year last year. Now,
one of the worst in history.
One of the worst in history. So bond prices are down, so bonds look more attractive today.
So you
I
can
do
get
believe
a
that
2-year at 4.8%. A lot of people say, hey, carve off 20% of my portfolio, move it into something I can get 4.8% on right now. Good move, bad move?
Well, I mean, that's what I think, like I said earlier, I believe
I'm asking the questions now. Earlier you were asking the questions.
Yeah.
This is kind of fun.
I believe that stocks, I've said this before, stocks will do better than bonds over the next 10 years or so. But when I talk about facts, I think we lay out the information
as we know it today.
as we know it, and then it's ultimately up to the client to decide what they're comfortable with. And I think that's really the gist of our conversation is, ultimately it's the client's decision. They're adults, and we give them the information. We can give them our opinion and our analysis, and then ultimately they decide how, what allocation or what they're comfortable with. And so that was our conversation.
The hard part about it is that these questions and comments come to us when there's volatility in the market, right? More so downside volatility than upside volatility.
Mm-hmm.
So if the market's down, The 9 out of 10 clients that wanted growth 2 years ago, now you've got 5 out of the 10 that say, whoa, hold up. I don't want the growth because it's too volatile now and I can't deal with it. So now cut half of that portfolio that was in stocks and lock it into a 2-year at 4.8. That's what happens when there's volatility. So there's so many things to unpack from what I just said, right? There's the psychology of of the value of your account. What do I mean by that? Client starts out with $1 million. We tell people, we're pretty straight up with people, and we say at some point in the next 5 years, you're probably going to see a 30% haircut, right? That's historically what it's been. So your $1 million account, if 1 million is the starting point, could go down to 700,000 in the next, I don't know, 5 years or whatever that time frame is. I don't know.
I mean, that's making the assumption that maybe at the very beginning, if you start with $1 million and then then you have a downturn, it could go down 30%. That would be terrible
Like
timing.
2022.
Yeah, but
January 2022.
right. I mean, if you start at that point, but
so what happens psychologically to people if their account goes down 30%?
But I mean, people are always anchoring. Whether you start with $1 million, it goes to 1.5, and then it drops 30%.
Explain that what that means.
So they look at the the highest value, whatever it was, the high point. So let's say you start with $1 million and it grows to 1.2 million, and then now that's your
my value is 1.2.
Yeah, that's your, and then it goes down 30%, and you're down 360,000. Something in that neighborhood.
Yeah.
And
it's at that moment. What did Warren Buffett say? If you can't.
He said that he was pretty blunt. He says, if you're going to do stupid things when stock prices go down, and by stupid, he means sell stocks. If you're going to sell then you shouldn't own stocks. It shouldn't own businesses. Yeah. And I think that's the message that I wanted to get across when we were talking earlier is, some people just don't have the temperament, maybe, to own all stocks. And even though that's the right medicine, if you're trying to build wealth, owning a business, there's no better way. If you look at the wealthiest people in the world, the common denominators, they own businesses. Elon Musk, Bill Gates, Warren Buffett. I mean, all these guys, they own businesses. That's how they build wealth. So, yeah, none of us are going to be Warren Buffett or Bill Gates and, be the top 10 richest people in the world.
Yeah.
But hey, in our own little world, we can build our own little wealth, our own nest egg, and we can kind of copy what they do. And that's basically what we are doing. We're business owners, and that's the best way to build wealth.
At a 10% annualized return.
That's
how you compound your money.
You're
every double 7 years.
Yeah, every 7 years
you double your money.
You double your money.
So right now you've got a 2-year at 4.8%, and I hear all over CNBC how great that is. And I think to myself, okay, in 2 years, where do we think inflation's going to be? 3?
I mean, it's going to be lower, but yeah,
2.5.
I think it'll be lower.
3?
Could be, yeah.
Let's say it's 3.
Okay.
You lock in a 4.8% 2-year treasury. Inflation goes down to 3. Okay. You're not making 4.8%.
No.
Your real return is 1.8% before taxes.
Mm-hmm. But okay, this is where I'm talking about the facts. I think we lay this out for clients.
Yes.
Which we have. And then ultimately it's say, hey.
And this is what Warren Buffett's talking about.
Yeah.
My portfolio is down 20%, 15%, 10%, whatever the number is. And I say I can't handle the volatility. Okay, the alternative is we can get you into a 2-year at 4.8 or a bond or whatever it is, 4.8. Let's even say 5%. We can get you into a product giving you 5% over the next few years. But inflation's going to, right now it's a loser because inflation's 6.4. But if inflation gets down in the next 2 years to 3%, you're making 2% on your money,
Yeah.
right? That, again, before taxes. Can you live on 2%? 2% growth. To me, no, but that's me.
Right.
And you got to understand, people listening, I'm all into stocks, and not just stocks, but options. And so I handle more volatility than most. That's where I'm coming at it from. But it just doesn't make sense to me.
Right. And I think you can communicate. We communicate that with clients. Ultimately,
It's up to them.
it's up to them. Yeah.
So if somebody they just can't handle the volatility, and they've been in stocks, and we explain all this to them, and they still can't sleep at night, okay, well then we'll buy you some treasuries, or bonds, but understand what you're giving up
Yeah.
potentially at the end, or of a bear market, beginning of, hopefully, I don't know if it's the beginning of a bull market or not, but at the beginning of a new bull market. Like, don't throw in the towel and settle, would be what I would say.
Yeah.
But if they want to settle,
Right.
we'll
I
let
mean,
them settle.
we don't have a choice. I mean, that's the way it
Yeah.
is. You
Yeah,
know. Well,
but real quick before we wrap up, that anchoring thing that you talked about is wreaking havoc to a lot of people. And whether their starting point, let's say that somebody started at 500,000, their account goes to 1 million, okay? And now it's at 900,000. They anchored their minds to 1 million.
yeah.
I can't dip below 1 million. It dips below 1 million to 900,000. Like, what?
It's a bad practice. It's really a bad habit to anchor. I've told several clients over the years that always always just shave off 20% off of the current value and say, hey, it could easily go down 20 or 30% from here. Am I okay with that?
Yeah,
And if you're not, then you probably shouldn't be in stocks. I mean,
yeah.
or you
That's the
should
bottom
be
line.
have a lot less stocks than what you currently have, because that's one of the things you have to accept by owning publicly traded stocks, businesses, which one of the great things about owning publicly traded stocks and businesses is they are the best businesses in the world. They are, and we have a chance to own the best businesses in the world and invest
Partner with
right alongside
the
Buffett.
smartest people in the world. Yep.
Yeah,
Yep.
we're investing right alongside Buffett and other really, really smart people, great businesses. But if you can't handle the volatility and the swings in the market, then you should ask yourself, hey, maybe growth is not really what I want. I want a little bit of growth, maybe more stability. I'm willing
Yeah.
to take less growth. And that's the case, then
I'm willing to make less money in order to have my drawdowns smaller.
and
That's the bottom line.
there's nothing wrong with that.
There,
If that's your temperament,
if it can get them to where they want to go, there's nothing wrong with it. But if it prohibits them from accomplishing their goals, there's plenty wrong with it.
right. And that's why we always say it's important to do a plan with Spencer and Matthew, and to
Yeah.
really know first of all, you have your goals and objectives, but second of all, what are your needs? What do you need as far as
Yeah.
income, and and that's why it's important to make sure that those match, and that if you need growth, you need it, but you're worried about volatility,
Yeah.
then okay, then we need to have another conversation. Maybe you need to bring your expectations down lower, or you need to invest for growth.
Yeah, and a lot of these people right now, that we work with are looking at leaving their kids money too, right? And so sometimes the goal and objective can be, yeah, I want to leave wealth to my children, and then to their children and their children. So we're talking multi-generational wealth, to where if that's what you want to accomplish, then you likely need growth to make that happen.
Yeah, there's no there and
So
I
whatever
bel
that goal and
yeah,
objective is,
if that's your goal to leave wealth to your children, you're not going to
then just turn off the
you
TV and the computer
you
and let
tr-
us
you
do
don't
our thing.
you're probably not going to go out and buy a 2-year treasury.
No.
That's not going to build great, wealth, build real wealth over time.
So here's the last thing I'll say on that anchoring, which I think is really important. I used to go around teaching workshops, and we would teach people what a trend is and what is the trend on a chart, right? And we would define a trend by higher highs. So if the S&P 500 makes a new high, and accompanied by that new high is a new low, a new higher low, right? So you've got higher highs, and along the path, you have higher lows.
Yeah.
And the only way you get to a higher high is if you make a higher low, right? And so if your account's at $1 million, really the only way it's going to get to 1.2 million is if it dips below $1 million, 900,000, 800,000. And then it goes to 1.2.
Mm-hmm.
And then from 1.2, 1, 950 to 1.4. And it's the higher highs and the higher lows. And that's what the market does. That's volatility. That's not risk. That's how money is compounded. And that's the price you pay for being in the market.
That goes back to what I said about shaving 20% off of your value.
Exactly.
Because it's going to happen.
It's going to happen.
20%.
And it has to happen.
Right.
For you to grow and become anchored, hopefully not, but to reach a new high in your account.
Yeah.
You can't do it with 4.8% treasuries. That's plus 1%, plus 2% after inflation. Anyway.
Yeah. Own great businesses. I'm speaking to customers right now. Look at your portfolio. Look at the businesses you own. Ask yourself, are these good businesses? Ask yourself, do I think these businesses will be worth more 3, 5, and 10 years from now? I think most people, when they ask those questions to themselves, they'd say yes.
Yep.
And that's ultimately,
would I trade ownership in this business
for the security of a 2-year treasury? No, I probably, but that's the question you should ask.
Yeah.
If you want that, dampen some of the volatility, that's what a 2-year treasury is going to do, or a 5-year or a 10-year treasury.
Yeah.
But you're going to give up some growth.
Yep. I like it.
That's the trade-off.
I hope this helps as people listen to this and they understand the psychology. And it truly is amazing to me. The goals and objectives of people change based on market conditions.
That's human nature.
That's human nature. I know. I get it. And I'm just hardwired just to look at a piece of paper and the numbers on a piece of paper and, okay, that looks better than this, right? And leave all that other crap to the side. But that's hard.
It is. Not everybody's, we've trained ourselves to be able to handle the volatility, and we know that not everybody, this is not what they do for a living. This is what we do. We've studied markets, we've studied psychology. Psychology and investing is so important.
Huge.
And to understand, it's very important.
Yeah. So if you're struggling with the psychology on your side, right? Clients I'm speaking to, reach out. We'd love to talk to you about it. And we hope these podcasts help. But I would say this, if you're nervous, we might go down another 10, 20%. I don't know. But as soon as that new bull market begins, history and the returns and the probabilities attached with that are pretty dang exciting. Giddy up, Brian.
That's right.
All right. Until next time. Bye-bye.